Where is OpenAI slightly weak compared to Anthropic? It's in coding. There were like different levels of deals, and like 10% is bet the farm. 1% is like an SVP deal.
The evolution of the story from, the models are everything. All these apps are just AI wrappers. The models have such market cap, they can buy the apps. And what you recognize here is no one knows nothing.
Any deal where you have 100% conviction to 5X, you should do it.
If I was the CFO of an Ivy League university, let's just say my cash planning for this year would be dramatically different than my cash planning normally.
Ready to go?
Guys, thank you so much for joining me again. I was inundated with messages from my LPs, from LPs that I don't have, asking to invest in funds. So thank you so much for that. Saying how much they loved our prior conversation. So both of you, thank you for joining me again.
I'm not here to help you, dude. I might just crash out now, but okay, we'll go with it for now.
Guys, I'm going to kick off with the topics I think we have to discuss first. Windsurf's $3 billion acquisition. It broke news. It was incredibly top of funnel for everyone. How do we think about this? How did you guys read it?
I mean, the first thing you do as a venture investor is you go bummed you're not in it. I mean, let's be honest. It's like an IPO prospectus. The first thing you do is you look at the ownership page and go, damn, right? Yeah. So that's the first response. You have to get over that. It takes a little therapy. And then you go, what does it all mean? And, it seems, stepping back, first of all, it hasn't happened yet as I understand it. It's been rumored, but TBD. But it makes sense. I mean, if you're OpenAI, if you're looking at what you're doing here, there's 2 or 3 Mongo huge use cases for your product. And you probably want to be relevant in those cases. And one of them is obviously one of the most visible is coding and picking up something in the space. I mean, just for 1% of your market cap probably is a sensible bet. So that was kind of the big picture response. Now you can get into, should they have bought Cursor? Did they try and buy Cursor? Are there a whole bunch of others? And then we can come back to the is it defendable argument, which I'll come back to in a second. But zooming out a million miles totally makes sense. When you're running a $300 billion market cap thing, that's predicated on a bunch of different end use cases, getting closer ownership of one of those big use cases makes sense. Jason?
I'm not convinced this deal will happen. I think Windsurf is pretty epic. I think that Varun's a great CEO, but we don't know, right? We don't know if it'll happen. Maybe Harry, you are closer to the pulse of anything on planet Earth, so you may know. But I'm honestly not sure the deal will happen. I do think. Listen, I do think the learning is 1% is really interesting. I'll tell you what I learned being a VP at a big tech company, okay? There were like different levels of deals, and like 10% is bet the farm, okay? That's like Adobe buying Figma. Like that wasn't the end of Adobe, but it's a big deal, okay? Instagram, 10% of Facebook. WhatsApp, what's the magic number? 10% of Facebook's value, okay? This is not just an SVP deal. This is the CEO saying, I'm betting the farm is 10%. You don't lose your job, but it's betting the farm. 1% is like an SVP deal. This is an SVP saying, I'm betting my BU. So my guess is whoever is at OpenAI, and where is OpenAI slightly weak compared to Anthropic? It's in coding. It's the one area it's weak. I mean, OpenAI, ChatGPT has pulled away. You cannot catch it. No matter what anybody says, you will never catch that revenue. And Anthropic's even given up there, right? But they own this coding, not just the developer, but the coding. And so 1% of your market cap to catch up, you won't even notice 1%, right? Now the VP may get fired if it doesn't work out. It's possible, but you really have to see when companies stall. M&A bets are very different, but when they're on the growth path, these 10%, 1% thresholds are like the bets you got to make. The clock's ticking, right?
My analysis honestly was like you either had to seed the market entirely or make this acquisition. They had to catch up with Anthropic, who are so far ahead in terms of that developer community and advocacy. And so they had to. And I think Cursor, bluntly, they couldn't buy. They'd just raised a new round. It was too expensive, and I don't think they would have sold.
Well, you can do, but okay, I'm not even, Sam Altman, he doesn't have any shares. I don't know whether he's the founder or not. It's a little confusing, but he can spend 10%. He can spend 30 billion, right? Interestingly, 30 billion is 10%, going to Rory's point, and it's 3x the last round. So I guarantee you the VCs at the $10 billion round will take a quick 3x.
But would you buy it at 30 billion if it's not as
I'm saying he can. I'm saying that he could. I don't believe it's unbuyable. I do not believe for 30 billion it was unpurchasable. It's possible. Like we've seen deals like Rory can share a few crazy stories of folks that turned away the Wiz deals. But even Wiz, it was just a game in the end, wasn't it? It was just a game to hit the number. And to avoid antitrust, and to avoid Biden antitrust.
I think the zoom out thing here is this: we all operate in one order of magnitude, and it's very hard to imagine what life is like 2 orders of magnitude further up. But companies exist 2 orders of magnitude further up. I mean, $3 billion is a home run venture deal, right? But these guys have a market cap of $300 billion. They're playing for one of the 3 or 4 companies on the planet that have a $2 trillion market cap. So you do what it takes to make that happen, right? And there's a period in every market where it's exploding. You really don't know how things are going to end up. And it's actually very smart and savvy to make some bets just in case it turns out that way. And picking 2 that are very opposite in terms of outcome. No one even remembers to the nearest basis point how much dilution Microsoft took to buy the elements that became Microsoft Office. I remember they bought something that was like PowerPoint. I think they bought a word processor. I can barely remember. I was around then, but it was the early 80s.
Tens of millions, I think, for
Tens
PowerPoint.
Of millions in the knowledge. Who cares? Got it done, right? Fast forward, example that didn't work, Excite at Home, search company, public, and the big idea was, oh my God, you got to combine search and literally the underlying piping. Let's combine with At Home, the cable infrastructure company. Turned out to be a deal as dumb as rocks. But what you recognize at the point in time when everything's happening so fast and nobody really knows, you're probably better off making some bets. And if you think about this particular bet, I mean, if you just look at the scope of the chatter, and I don't love chatter, but the evolution of the story from, the models are everything. The AI, all these apps are just AI wrappers. That was kind of conventional wisdom a year ago. I mean, an infinite amount of time, but just a year to, oh my God, models are commodities and, AI apps are all it's going to be to, oh my God, now 3rd iteration, the models have such market cap, they can buy the apps, right? And what you recognize here is something I said last week, no one knows nothing, right? So the thing I admire about Altman from a distance, I don't know the guy, is a bias to action. You sit there and you go, there's 2 or 3 massive use cases for AI. One of them is direct chat, tick, done. Second one is coding, Third one is customer success, TBD later, right? You're just moving down the to-do list. I think doing something makes sense here, and you can't unsee it now, right? Even if this, to your point on Wiz, even if this deal doesn't get done, the mighty corporate intent has been stated. We need to own one of those things. If they don't do Windsurf now, the line of other coding apps outside the OpenAI office is going to go around the frickin' block. And at some point, someone's going to buy something. Will it work? Again, who knows? Will it be PowerPoint or will it be Excite at Home? That's, as they say, why they play the game. But not making a move is akin to losing.
Another thing that maybe people miss a little bit on M&A is you don't have to, if OpenAI does buy Windsurf, you don't have to do the brutal Salesforce Oracle strategy and say it's us or nothing. You can build a platform and let the customers decide. Totally. You really can. You can say, listen, it's now Windsurf powered by OpenAI. If this is the bet, we're going to put 1,000 engineers on this. But if you want to use Cursor, if you want to use any other system, we still love you. And you don't have to overfavor your platform. You do not have to. And I think OpenAI, my guess is they'd handle it very well. Right? They do both. And a lot of companies that do this, they have different teams, totally. Right? And they just let the market decide. It doesn't have to be ruthless. If you have a platform, you can actually see them both. It does happen.
And the best example of that is obviously Microsoft, where, they had the operating system, they had a dominant set of apps, but there were other apps out there. And, Jason, one thing I would disagree with, you say you don't have to be ruthless. You don't have to be ruthless in the short term, but, one of the things you see is in the end, there is a grinding you down element to it, right? After 20 years of the PC wars, there was really only 2 or 3 companies at scale that were selling apps that were personal productivity apps independent of Microsoft. It was, you had Adobe, you had Quicken, and maybe some of the security apps. So I agree with you. They can definitely, if they buy this and favor this, everyone else will have to use their shit because it's one of the 2 things out there. But it'll be a long 10-year grind if you're the independent, if they can make it better and better.
as a venture nerd, my takeaway was going through the cap table and seeing who did the first rounds. And what do you see? You see Neil Mater, Green Oaks.
Totally.
Neil Mater. And it brought me to something that I was just talking to a massive LP about today. They said, Harry, tell me a seed manager in San Francisco to back. Give me a seed manager. And I said, I wouldn't touch it. I wouldn't touch it. The multi-stage fund product at seed is so good, so efficient, and their cost of capital is so low that they're just crushing everyone at seed. And this, for me, is another example. Green Oaks leading the seed, doubling down on the A. I think all of the multi-stage firms are pushing out the seed firms more than ever. And I think this is a great example of it.
How big's that fund, Harry, that Green Oaks fund?
It's between 1.5 and 3, and I know it's a big range, but
so if they own 10% with dilution, going to your point last time of Insight and Wiz, even if they own 15, how much of the fund does it return?
It reportedly returned between 500 and 600, which is less than a third still on the smaller fund.
Venture's brutal.
Yeah,
less than a third. So you need to do a 5x fund. How many Windsurfs do you need? Help me do the math.
Just 15.
15 per fund.
Yeah.
But still, it's been my experience. You'll still cash the check for the first 500 million and smile. I mean, I always say that to people when they say, "Oh, it's only a 3x or it's only a 5x." I've been doing this for 30 years. Everyone cashes the check, right? But going back to that, I just got to say, go back to the Green Oaks comment. I'm not sure it says something systemic about seed versus non-seed. I just think it says extraordinarily good picking from a very connected investor who just, most of whose stuff is working really well at a much higher level. And to go from, later stage deals to reach down into the early stage and unerringly pick a winner like that, all credit to him. I mean, just got to say, great success. Go team. Yeah. The only thing that counts is winning, and no one gives a damn how you do it. Well done.
I do think your point, though, about the squeezed white space for seed funds is a good one. And I do think, if nothing else, it pushes ownership down, right, at a time when seed funds are larger. Going to Rory's point last time of risk, I think it increases the risk for seed funds. I think when this multi-stage thing now that starts to get perfected, like on a Windsurf, right? If you're scraping for 2 to 3% as a seed manager instead of 12, and your fund has doubled in size, right? So the outcomes have to be double. It's like it's a compounding set of risk pressures, right, on seed. And I think for seed managers, can $1 billion outcome even return the fund anymore for a seed manager? Like, that's the old line for seed, right? $1 billion outcome can return the fund. I don't think it's true of a lot of seed managers anymore. I don't think $1 billion let alone do 3x net, I don't even think it can return the fund. And that's a big challenge for seed if a unicorn can't return the fund.
Yeah, no, I funny. I was reflecting on our conversation last week, and Jason, your comments on seed, and I was laughing about it. Your quote on seed for circus is that one of the things I've internalized is everyone is looking at everyone else's spot and going, "My spot is hard. My God, theirs looks easy." Right? And we all do it, right? The dirty little secret is it's hard everywhere. There's a lot of capital, a small number. It's just really hard to make money, and because of the amount of capital in the business. So I don't know if structurally seed is risk adjusted less attractive than A or B, would we play, or is it then late stage where Green Oaks normally would play, or whatever, right? I just think every stage is wrestling with, and the proof of that is everyone is kind of drifting into the other stages and saying, "Oh my God, I need to do that to do my thing." And it's just a very messed up world at the moment, and no one's staying in their swim lanes. And I think a lot of it is the super big funds doing everything, which, full stack providers kind of make everyone question what they're doing. And we'll see over time.
The one thing that I really see, though, being at seed and A, there's a lot more dilution sensitivity at seed, where very often today the whole round is 10%, and we're able to do 7.5 with 2.5 for angels, whereas before it was 15 with 12.5 and 2.5. And I've really seen that compression from 15 to 10 on the seed rounds.
You can afford to be dilution sensitive as an entrepreneur if you can get cheap capital, right? You can only be as sensitive as the other side will let you. Right. So dilution incentive is another way of saying, dude, I have 3 more people lining up down the street to give me a better term sheet. So you only taken 10%. And if you don't like it, shove it. I got more money. Right. It's a lot easier to get better ownership when there's just less capital. Right. Barton Biggs used to have this saying before, there's no business so good that excess capital can't ruin it. And here we are.
I mean, speaking of excess capital, I was with the team today. We literally just came out of an investment meeting, and what company that we were looking at has been done. It's doing, 7 million in revenue, and it's been done at 700 million by some of the big funds. And I said, wow, we're back, huh? Return of the 100x. Are we back at the return?
Well, what's the forward multiple, though? I think 100x was always a misnomer. I don't, maybe Rory would disagree. I think it was always when we look at forward multiples, it's a better way to think about this, right?
Totally.
Forward multiple is about 33x.
Yeah, which means it's 3xing. So let's start with that. And let's start with the very basic. And I'm going to say something here. You're a hypocrite. I'll tell you why I say that.
Me, not Harry. I'm the hypocrite. I'm deflecting.
Harry, because you pay the highest investment multiple. The truth is this: the entire venture business starts off with an infinite revenue multiple and gradually comes down, and multiples go down over time as growth rates deaccelerate. And what you're trying to do is hope to God that the growth rate stays higher long enough to de-risk the multiple before you intersect the public markets. And in the end, everything trades at 5-6 times revenues if you're growing at 20%. Right. So, you've done deals. I mean, your last seed deal, if it's doing $500,000 and you're paying, 30, 50, whatever it is, it's 50, 100x. Right. So the real question is, that's the first thing. It's stage dependent. And then the second thing is, Jason asked the right question. It's growth dependent, right? I mean, my partner, Andy, says, Lily, we'll refuse to have a conversation about revenue multiple unless you state also the growth rate. He's like, it's an incomplete equation, not worthy of discussion. So when you say 100x growing at 3 or 4 times with high growth persistence, which is a term we coined for likely to stay growing at that rate, in 2 years, you're out of the risk zone, right? 100x, if that growth rate is sub 2% and starts to decline, you're so screwed your head will hurt, right? So it's situation dependent. And, so that's what you have to say. So kind of taking that and going back to 21, I think what happened in 21, a lot of people paid up for growth rates at 100x and then didn't get the growth. And that's a fiasco, right? So this time it boils down to what people are paying up for growth again. Will they get the growth? Will that 7 million become 20 or 30 million? If so, and you get just one more good year of growth, you're at 60 or at 10 times. It's kind of a scary way to live 2 years of your life, but it's not impossible, right? If it slows down, you're screwed.
My challenge goes back to our point earlier, though, which is just like understanding sustainability, the transients of product market fit, the transients of revenue. So yes.
Totally. No, you're exactly right. If you lean in and it goes away, that's why those 10 years of SaaS was such a good business, because it was predictable, because the input of sales and marketing to the output of revenue was predictable, because the revenue was sticky. In retrospect, it was the golden years of just apply capital and grow into the multiple. Right. And if it's not like that, I mean, our younger partners, they don't say it, but you can see it in their eyes. They're saying to me, you idiots, you made money when it was easy. Don't give me shit now. It's hard today, brother. Right. And to some extent,
I think it's true.
Right. Yeah, they're right. I don't like to admit it, but they're right. Today, predicting which of these companies can keep up that growth rate, it's just there's much more variety in it.
When I look at Klaviyo, when I look at UiPath, when I look at Service Titan, the list goes on of companies that actually took a long time to get to 1 million in ARR. They really went through the kind of idea maze and product maze to get to a good number, being in the 1 million in ARR. My question is, are we in an entirely new world where kind of today, from day one, you're at the start line and you don't have the 5 years to weave and snake? Or actually, are we still in the same world?
Well, weren't they all, we could go through a history, weren't AnySphere, Codium, whatever Bolt was before, didn't these all struggle for a year or two before they took off? I mean, I know Cursor almost died, right? Bolt almost died, right? And then finally it hit for Cursor. I don't know the whole story of Windsurf. Even Windsurf was Codium before it, right? It wasn't even the same. Like, everyone talks about Windsurf. 90 days ago, Windsurf barely existed. 90 days ago, it was a Chrome plugin called Codium. Now it's like taking down the market leader.
I think the revealed pattern in kind of SaaS land was, and I think of it as this, man, the walk in the wood period is indeterminate. It can be a year, it can be 6 months, it can be 5 years. It doesn't matter. It's up to them, right? You're financing that journey at seed. And as long as they don't run out of money and they want to keep doing it, fine. Once you lock in, the interesting thing is the trajectories now are different. The SaaS trajectories lock in, and Jason knows it so well, treble, treble, double, double, and that steady thing. The weird thing now is once you lock in, as you say, in 90 days, you go from, or maybe be fair, a year, 6 months, a year, you go from this company's not going to make it to, oh my God, I think I'm going to turn down $3 billion, right? That's what's different about today versus SaaS land. You know, when you get to product market fit, the action and the odds at the craps table are pretty wild, right? In a way that just didn't happen in SaaS land. I mean, it's just like, yippee, we won $3 billion.
Why? Sorry, just help me. Why is that? Is that because the distribution that's different, the adoption that's different, the willingness from large enterprises to pay for AI tools is different? Why is it when you get PMF, it's like crack instantly to 3 billion in 90 days in a world where it wasn't before?
I think it's all the above. Actually, it's a pretty good list. I think that, stuff is working quickly and people are adopting it quickly. So you have that just raw take up. There's a common consensus that the prize is worth taking. Right. The important thing about AI is that if you compare the hype, if you look at PC hype, internet hype, and AI hype is bigger than all the other hypes put together in terms of just raw belief that it's all going to matter. Right. I mean, 4 years into the internet quote revolution, I mean, Krugman was still doing that. Maybe it won't matter. And I'm picking on Krugman, which is not fair because God knows we're going to need international trade economists in today's world. But there was still, is it matter? Is it all just a bunch of kids? Is it all stupid? 2 years into AI, everyone on the planet and every company is saying, shit, I got to do something here. Right. So there's a common consensus across the entire knowledge worker world and the entire corporate world that this shit matters. And when you have that, I don't think you turn up to your board and say, well, AI really matters, but I'm a bit nervous, so we're not going to make a big play. Maybe we'll get someone else to run this operation, right? So I think there's just a willingness to bet big.
I think it's the one thing, I was, Harry, I caught up with Mark Benioff the other day and about AI, and his feedback was, we have a group that's all in, right? And he had all his logos, the Leonard Holmes and Singapore Post. And he's like, but I got to tell you, it's so early for others. It's so early. And what I thought about that, then I thought about it for a minute. What are we seeing happening? This is just my sense, okay? I think what's happening with AI is every early adopter in the world is looking to deploy. Okay, every single person, whether it's an experimentation budget, whether it's a restaurant that actually cares about AI whether it's the three of us, I'm running our SaaStr AI, I'm running on tools, I'm ready. And from 2021 to 2024, you couldn't get me to look at anything. My life was too busy. So I honestly just think this growth, it is crazy, but it's a moment in time where every early adopter is in market. 100% of the early adopters are in market. And that's why I think it's early, because 90% of sales, the enterprise is not even there. They're just playing with ServiceNow and they're just playing with things. But I just think this growth is, and a lot of it is self-serve and product-led and easy to deploy, and it's cheap. These products, if you don't use much any Windsurf, it's $20 a month, dude. This is not high risk. I mean, you have to put it into production, but this is not 400,000. They have an enterprise sales team. All these products are cheap, guys. Totally. These products, my jaw drops how cheap these products are, and they make regular B2B look like a friggin' ripoff. And so every early adopter's like, I can use Higgsfield for $5. I can use Windsurf. Why wouldn't I? I'm in market, right? If it was 20 grand, which is what a traditional, just to get Atlassian to engage with you is probably 20 grand for the enterprise, right? For some 20-year-old tool. But man, $20. $20, right? So I just think every early adopter is in market, and that's why we're seeing growth at the levels we have. I don't think it's as crazy as it sounds. Just instead of 5% being in market, it's 95% of the early adopters.
One of the other investors in Windsurf was KP, and there was surprising news when I saw that Bucky was leaving KP. Bucky's kind of heralded as one of the successors, and it's just one of another younger people in venture leaving one of the bigger brand name firms. I'm intrigued to hear how you thought about it. Jason, why don't we start with you? How did you read this? And what are you seeing in terms of younger people leaving brand name firms?
Well, first of all, honestly, I in a way, I was accidentally an early version of this, okay? If you have a hot hand in venture and you're not running the place, I would leave the next day. That's what I did. I had the same conversation with Tomas Tungus, who just already raised like 700 million. Everyone loves Tomas, right? And I won't share all the conversation, but one of his things was I should have done it earlier, right? As great as Redpoint is, he's basically a solo GP managing coming up on $1 billion. Probably better economics than being paid $400K to $1 million a year plus waiting 22 years for some carry. I mean, why? I'm not saying that's what happened with Bucky, but probably if he was going to run the place in the next 5 years, he would have stayed, right? Or whatever the dynamics are. It's just, if you can raise your own fund today, you would be silly. And I know it's not true at scale. I'm not saying it's true at scale, Rory, but at 90% of VC funds, why would you stay? Be given, when I worked for someone else's venture fund, I was told what my salary was. I mean, F you. I did 10X in that fund, and you're going to tell me what my salary is? And I don't even get to go to the management meetings in a tiny fund? F you, right? I mean, it doesn't. Why would anyone stay in those environments?
Rory, listen, you're on the other side of the table. Fascinating. You have amazing young people. Why do they stay, and what would you say to them?
Well, first of all, I'm laughing. I remember meeting Jason for the first time. I'm going to say, you said, if I wasn't doing X, if I had a hot hand and I wasn't running the place, I'd leave. Knowing you as I do, Jason, you can delete the first part of the sentence. If I'm not running the place, I'll leave. Some people just want to run the place, and that's you, and I totally respect that, right? I'm giving you shit here.
No. Sometimes you just want to be a partner. As a founder, you don't need to run the place. You just want to be a partner, right? A true partner, not a general partner or whatever. You want to be a true partner, right?
That's actually a much more actionable comment. I agree. Yeah. I think, because I don't think it's as easy as, hey, I just want to leave, because it's non-trivial. There's a bunch of stuff required with raising a fund and all that. And yes, if you pull it off, it's great. I like your distinction. I think people want to work in an environment where it's fair in the sense of their return, the compensation they get is roughly commensurate with the value they put into it. Right. And that's hard to do, especially in a business with ours, which has such long lead times and such long proving out times. But if you don't build that kind of organization, then you don't have, you need to do that to have generational stability. So I think, starting with that comment, because there's a lot in this comment, right? And, you want to make sure that everyone, in a rational world, everyone's incented to stay rather than leave, which means, brutally put, and no one ever says this, but the implied statement in this is, the hotter your hand, the more incumbent it is on the leadership of the firm to make sure you're in the circle, not out. I think it's centripetal, where you're pushed in, right? If you're sitting there as a leader and you've got a hot, talented, younger partner and they're killing it, right? If you're not putting them inside the tent as quickly as humanly possible, you're an idiot. Right. So so the good thing about that is the system works. It's polite, because venture guys are politer than your hedge fund guys. But in the end, well-run firms make damn sure in the main that people who are doing well get promoted and cut in. And that's our job. And if we're not doing that, you're right, you'll start to lose good people, and shame on you. Right. So that's the job of, quote, the established side of the table. The specifics are all over the map. And I know Bucky, I know not as well. I know Mamoon very well. I remember when Moon was a young guy moving on from his first firm. We've all been on both sides of the table, right? I'm not going to comment on specifics, but there's a range of ways people leave. Sometimes it can be that I'm doing great and I am not getting the reward I need. Sometimes it can be I'm doing great and there is no freaking reward because everyone else has lost all the money. So no matter how hard I work in the next 5 years, I'm just digging out of someone else's hole. Right.
But do you think we will continue to see spin-outs from A-grade firms, from young, incredibly promising partners?
Well, I think it's the nature of the business for the last 30, 40 years, so I see no reason it'll change now.
Well, it is, but the level of spin-outs has been significantly increased.
But that's only because, again, risk of sounding all that. That's only because your window of view is fairly limited, right? If you look across 30 years plus, right, it's exactly when it should happen. People are there with there's two reasons why it should happen now, and one reason why it might slow down. The reasons why it should happen are, one is you've had 5 or 6 years of slowdown of, what looked like amazing performance, lots of promotions, and then a whole liquidity gap. markdowns, and everyone's looking at the last two funds and saying, oh my God, I cashed the if I was here early enough, I did great in those early funds. The last two funds, maybe if I hang in another 5 years, we'll make a 1.7x. Maybe I'll make some money. If I'm a junior person and hot to trot in my career and I think I'm good, I'm looking at that going, the expected value of this isn't great. Right? I'm a rational actor, and anyone who's running money should be a rational actor. So the first thing that's causing it is big-ass firms where you're not sure you're going to get money. And then the second thing that's causing it is LPs still wanting to do the asset class, but it's really funny, actually, and wanting to do new firms while simultaneously also doing huge checks to the very same firms that people are leaving from, right? And it's just quite a funny dynamic. And I think what's really happening here is, and this is perhaps too setting, is that deep in their heart, you're kind of looking at these mega platforms and going, I got no choice because it's the only place to put a lot of money, but oh my God, I'm scared. I'd really like to feel good about myself in the morning. I should do some young up-and-comers too, right? So, I put my $200 million into mega fund and I gave $20 million to Tomas. I feel good, right? And I think there's quite a receptive market at the moment to...
do you think you suffer from the barbell, respectfully, Rory, which is exactly that? You want to put money in the sub 100 young new firm, or the platform play with multiple billions and GC Lightspeed Andreessens?
I think suffer is an interesting word. I mean, I think we're all only as good as our last game, right? I understand what you're saying. In a world where people say there's only two things I want to do, the mega funds and the design of new funds, yes, in that world, I would suffer. But that's not the world that worries me, because there's something that worries me more, right? The world you really suffer is if you don't perform, right? And if you do perform, no one gives a damn if you're small, medium, and large, right? Things out paying. It doesn't matter if a mouse is black, a cat is black or white, as long as it can catch a mouse, right? That's why I said to my colleagues, I say, guys, we're competent, but our number one job is to be competent. Right? If you execute, I believe there'll be a market for venture returns. If you don't, then you're right. Then you have in the absence of success, people can impose their biases, and then, different, and you're right, at the margin, people love these new firms, the new stories, because it's the promise of the new, right? The other wonderful thing about starting a new firm right now that no one will ever say, not only do you ditch your colleagues' track record, you also ditch your own. Right? You literally go there and go, I was at mega firm from 2016 to 2024. I did some deals. Some are great. Some are shit. It's not obvious yet, but deep in my heart, I know. I'm just going to sever that thing like a stage of a rocket, move it behind, raise money now, and I will never be asked about my mega fund return ever again, as long as I make this new fund work. It's beautiful.
Well, you still tell the stories of your winners from the prior fund, right? Yeah, and you can just pick out your own returns and your own results from my winners, right?
To take an example of that, who I think is by far one of the most talented investors of the last 30 years. I mean, Fred Wilson. Flatiron was wildly unsuccessful in the dot-com crash, went on to do a new thing and killed it from day one, which is why it might also be a sensible bet. You sever your own track record, good, bad, or indifferent. That, frankly, was largely a function of the times, not you, right, which people don't ever want to say. You learn those lessons. You're way more intentful as a startup about what you're doing, and therefore you kill it, right? And that is the cycle of renewal that can happen. Right. So it's not crazy forever. It's just one of those things that happens at this stage in the cycle. Good for them.
The one thing I would say is I would not want to be going out fundraising at this time. The LP appetite for new funds, I think, is lower than it's been in a long time. LPs are not jumping at the bit to commit to new managers, either existing re-ups or net new. LPs are waiting.
They don't want spin out. You would know better than me, Harry. I'm shocked that the spin out play, maybe it's for the reasons Rory said. I think the spin out of the successful GP, right? It de-risks it on the 2x2. It's not the spin out. It's not the 2021 playbook of I'm getting three buddies together to do an $80 million seed fund. This is cherry picking a top manager from a known brand fund. You would know better than me. I think there's still appetite for that.
It depends who and where from. Your Mike Volpe's Your Mike Volpe's from Index all day, every day can raise 10 times whatever he wants to raise 100%. But the withdrawal from endowment funds is very real. The awareness that fines is coming, very likely for many of them, and tax exempt status is at risk, means that there's just a lot of uncertainty and a lot of them are just waiting.
I agree. I think that, as is often the case, two things, especially when you have three people all busy talking past each other, two things can be true at the same time, right? I think that Jason said it right. The large number of new funds that were happening in 21, whenever it needed to be in venture, is way down. First statement. Second statement: the funds that are getting done are talented mid-career GPs from top-tier firms with good track record. A much smaller number, but we all know them by name because they've been in our business for 20 years in a way that I didn't know, Joe XYZ, who raised in 21, I'd never heard of, right? Every single one of these people, you go, yeah, that makes sense. We're in a deal with them. They're smart. They're good. You do references. They're great. But I do think, to last your point, that was then, and this is now. And the interesting thing about the next couple of years will be, is there pressure on endowments, who are typically one of the best funders of new designer funds, high intensity, high conviction, smaller funds? Are they in such a world of hurt in the last 2 or 3 months that even with the best will in the world, they're just not going to be able to do these deals? And I think that's a legitimate question, which is why I think it won't always be the case that every young person says, yay, I've been successful, I should leave. You might see in the next 1 to 2 years a little bit of clinging to the lifeboats here, guys, because it's not going to be as easy as it was. I think 23, 24 was a unique time where it's never easy to raise a new fund. These are really talented people. But 25, 26, you're right, Harry, could be tougher because you can want to do something all you want. You can want to buy a Ferrari if you want, but if you haven't got the money to buy a Ferrari, you can't buy a Ferrari, right? And these guys are going to be really strapped for cash.
Rory, can I ask you, do you think the endowment funds are as in crisis as people seem to make out?
I wouldn't be surprised. It's a terrifying set of circumstances. I mean, if you're an endowment, we'll talk in a second about the Yale thing, is that, you have down public markets, you have illiquidity, right? Those two, and you have, low venture returns for a long period of time. Those things alone would have put stress on the system. And what typically happens when you see stress, then it's the exogenous variable that puts you over the top. In 73, it's the oil crisis. In 25, it's the Trump crisis. He has clearly taken on himself to decide to to significantly change with brute force a significant slug of the very institutions who have large endowments and are providing a lot of capital to these startups. So I think deliberately not commenting on the merits of it for a second at least, if I was the CFO of an Ivy League university, let's just say my cash planning for this year would be dramatically different than my cash planning normally. And if someone sauntered into my office and said, we need more illiquid assets, I would say, get the frick out of my office, right? We don't. I'd be like, no, I'm thinking bonds here, dude. I'm thinking, index funds. I'm thinking accessible cash at a moment's notice when 30, 40% of my revenue could disappear.
Rory, I literally had across channels 50 plus LPs in my inbox post our last show. They will all be screaming, okay, but if I don't do these venture funds, I'm going to lose that trusted relationship with Mamoon at KP, with Danny at Index, with Brian at Founders, you name it. I can't just go, no, I don't want more illiquids. So what would you advise them with that in mind?
Two things. Going back to your prior comment on new funds, what they're saying is, I don't want to lose what I have. And what you see then is the bias to, I got to start by protecting what I have, the relationships I have. Yeah, it would be a mistake if you've been in Sequoia for 30 years and you've one shit left this year. And option A is nuke Sequoia and do this new fund, two really smart people. They could be amazing, right? And option B is keep a Sequoia relationship. And because those guys do vindictive like no one else, that if you pull out, you're done forever. What are you going to do? You're going to probably stick with your existing relationship. So first of all, you're right. They themselves have to make choices, right? And then, and I think we mentioned it last year, then the second thing is, at some level, some choices get made one level above you. They can say, I want to keep rather than add a new one. And that's one choice. And then someone one level up says, I want liquid assets rather than illiquid assets. right? And it's liquidity premium is one of those words that doesn't mean shit until it means everything, right? And when you need money to fund your students or to pay your professors or to fund your research, right? You know, you're going to be saying to yourself, people do, you end up selling, you end up giving up on upside either by not pursuing new deals or even, shock horror, selling existing assets because you just need money.
And we are seeing that. Yale are reportedly selling reported about $6 billion pool of different assets in a secondary sale. Are we going to see that? Is that the start of a new trend for endowment funds in getting the liquidity they need for the outflows that they have?
I mean, and Jason, chime in here, because I went on a rant there, so I don't want to hog the mic. But I was thinking about this because it's a really, you know, I was listening to your list of questions, and this question is a big deal because, you know, Yale has been the intellectual godfather of the endowment model. And in David Swenson's book, I'm sure we've all read it. I read it 20 years ago, and I'm like, that's the definitive book. I don't need to read any other. This guy nailed it cold, right? And, you know, the Yale endowment alumni have gone all over the world. You know, they've been hired. They've been at, you know, the court of the king. They know how to do it. It's spread across many endowments. And intellectually, as I said, this would be like if Vanguard said, you know, we've been thinking active management is the way to go, right? So, you know, right? And the question is, what's really going on here? So, because there are mitigation circumstances. I mean, I was mentally running through. First of all, the rumor might be not true. I think it is, but I don't know, right? But there's 2 or 3 reasons why they could be doing it in, how'd you put this, ascending order of severity, right? The least severe is, hey, we just think we're going to need money. It kind of sucks. We love these assets, but, you know, we just need capital. It's not a knock on the model. It's just a knock on, you know, I didn't plan for the fact that the President of the United States might try and effectively take away our federal income, right? So there's no collapse of the intellectual theory. It's just you misjudged the amount of illiquidity you could afford because you misjudged the variability of your cash flows. That would be a conclusion that it's bad short term, right? Because it's bad and it speaks to other people having the same problem, but it's not saying the whole model falls to pieces. Obviously, an even worse conclusion would be they've been looking at them thinking and saying the entire private sector is overfunded. I want to pull back a little. And we just think systemically long term, that's not the case. But it is a big deal because they're so damn good and good for so long.
Yeah. My only limited insight, you guys would know better than me, but in the few conversations I've had is one, everyone got their distribution planning wrong, their cash planning wrong. That's what happened in the industry. This is even pre-Trump, pre-everything. This is conversations I had late last year with LPs. Is we're cool with our paper returns. We're cool with our gross and our net IRR, but our cash planning was just wrong. We did not plan for this liquidity drought to last this long. Okay, this is what I heard. So cash planning was off. I heard 2 things. The second thing I heard, and I know this is 20 VC, not 20 PE. The second thing I heard is venture, whatever, it's PE is the big problem. They're really the same thing. I mean, venture is a subset of PE, right? And the PE is so much bigger. And the fact that these deals did not go public in 2 to 3 years is the bigger stressor. Venture, they don't love it, but they're modeling 20-year illiquidity with regular cash outs, right? But they don't sweat the VC as much as the PE. I think we're suffering for that, for the bigger cousin.
What does that mean? Sorry, we're suffering for the bigger cousin. What? Because PE hasn't had the liquidity.
Because they're putting 5 times as much into PE or 10 times as much as venture. Venture's a rounding error in most endowments, right? It's a subset, just like seed is a subset of venture. Venture is a subset of PE. It's not that important. It's just juice, right? It's just a way to juice your returns. PE is where you deploy more capital. And if it's been 5 years and your cash flow models are off there, right? They haven't brought, it's great we bought Zendesk and Anaplan and Schmanaplan, but if none of them are returning cash, that's an order of magnitude bigger issue than these little 8 or 9 figure checks into scale or 20 VC. Those are rounding errors. Those are just juice. Those are to get some extra basis points and on the overall endowment, right? I mean, there's exceptions, right? There's but mostly it's juice, right? Mostly it's a little extra alpha on the endowment.
Don't forget Cooper and Zuper and Duper. I mean, that's
that's the stress that this is pre-Trump, but that's the bigger stress than venture illiquidity, right?
We constantly go in and out of like denominator effect on their public books and where it's weighted according to their privates. And every time we have a big swing in publics, everyone's like, they're feeling the denominator effect. And I'm like, is that really a thing given the increasing volatility of public markets today, meaning that you're constantly in and out of denominator effect danger?
It's a thing, but it's not the thing that we're wrestling with now. I mean, I think when you have, a lot of things in life can be problems, but the question is how serious a problem, right? The denominator effect, right? It often happens when, just in case any of the readers don't know, is that you have a target allocation to private equity. Say it's 10%, everyone's going great, but then the public markets take a bath and you're just at allocation 1090. Public markets take a bath, that 90 goes down, so your allocation and the privates don't market as aggressively on either side, so your private allocation goes from 10 to 12. So you have, quote, a denominator effect. It's an issue, and I've definitely had conversations with people over the decades where that's a thing. But I don't think if that's all that was happening, I think people would power through, right? I think Jason's exactly right, which is it's a combination of, at a minimum, maybe it's three things, but it's at a minimum, the cash models have been wrong and it's all taking longer. That's what we know for sure because it's true. The second thing we don't know, but that's the scary thing, is we don't know. Are our models wrong on timing, but our IRR's good? In other words, are we still going to get the return we want from this asset class just over a longer period of time? Same IRR, but just compounding for 6 years rather than 4 in the case of PE or 12 in the case of 8 for venture, right? In other words, am I still good for my 17%, which is 600 basis points above small cap return? Or, more concerning than just timing, has that 17% gone down to 15 or 14 or 13? Am I getting paid? Because now I've got not getting paid for the risk. I'm taking the risk and I'm not getting paid. So that's the second issue of my returns there. But the third issue, and most catastrophic, which I think is particular to the endowments now and not anyone else, is I actually need the damn money.
I think that is actually very pertinent though to the endowments, because they have a lot of the time mandated outflows, which they have to spend on upkeep of community facilities, scholarships, where a lot of other institutions do not have the mandated outflows.
But when that happens, things just get harder. And I would be look, it's just who here on January, 6 months ago, I'm willing to bet if you looked at, because endowments do June 30 to June 30, no one had on their plan for FY 624 to 625, which is the current period. Don't forget the plan for the President of the United States taking away 2/3 of our funding. Oh, didn't have that in the plan, right? So we're just dealing with such extraneous, it's just so off the norm, right? That I'm sure everyone got caught. It's like saying COVID. I didn't have a COVID plan in January 2020, right? Neither did you. Neither did anyone. Right.
I hope they're happy too. I hope Harvard and everyone's happy, because I know I'm not going to write a big check because they poked the bear. Like I'm not sure whether I have empathy or not, but all the emails saying please give us more money, like it ain't going to work on me. I ain't gonna write a huge check because they poked the bear. It's not my problem.
The last thing my wife said to me, because we are paranoid former green card holders who have now, thank God, naturalized citizens, she said, don't say anything that will get you singled out to the president. Literally last thing she said before I walked upstairs. So I'm just not being political here. I'm not joining your bandwagon. I'm not joining in on that. I'm not joining in against it. I'm just a simple, humble, naturalized citizen who wants to stay in this country. I do feel a little empathy for some of these organizations, despite their prior sins. It would be a longer conversation, and let's not do it.
The one thing I will say is I was surprised when we raised the fund last year, whatever it was, 9 months ago. I obviously spoke to a lot of tier one endowment funds. The amount who had over 30% in privates was shocking to me, and over 30% even in venture was shocking to me. Like that in my head.
I didn't know there were that many with 30% in venture. That I did not know.
In my head, it was a 6 to 10%, honestly, Jason. When I heard 30 from 5 plus big names that you would know, I was like, whoa.
Again, reciting my David Swenson, one, it's not shocking if you have the perspective, which you should do correctly, that the longest lived institutions political institutions in the world, or kind of corporate institutions in the world, other than the papacy, are the universities. They have, decades and centuries timeline. A bunch of Bologna was 30. Oxford and Cambridge were 13th, 14th century. Harvard is, I think, 18th century. These guys have multi-century timelines, and if the longer the timeline you have, the more you can take on illiquidity risk, provided you're getting paid for it. So it's not crazy for these guys to have done that in a world where your plan was to disperse 3% of your endowment at most every year to fund scholarship needs. You just didn't plan for the situation where the world could change utterly. So I get why they're there. And I didn't go to any of these, but I'm going to come back to it, Jason. I am more than mildly sympathetic despite their past sins. I think there's pounding, there's trying to drive change, and then there's pounding too hard. I'm just looking here. My God, and as a non-American university graduate, I never thought I'd be given this commercial. But this is one of the best products we have in the country. We get foreign students to come over here, pop down 60, 70 grand a year without blinking an eye and ponying up for our education. And we get them to feel good about us afterwards, right? It's not clear to me why killing this particular golden goose is a good idea, but that's not my mandate. So I've got that off my chest and I can move on now.
I think that was fantastic. I think your wife would be thrilled.
We never know.
Okay, another one that I saw this week, which I thought was really important, was actually, I think it was Bryce from Oat VC, but he was essentially saying, if we're building single-person billion-dollar companies and AI makes it so much cheaper to run companies, why are rounds bigger than ever? Traditional seed companies. Rounds are bigger than ever. Why, if everything is much more efficient?
Well, look, first, obviously, everyone wants to invest in the companies that don't need their money. So as valuations inflate, they're just going to absorb more capital. Two, so that's number one. We all want to invest in things that don't want us. Two, founders are utterly insensitive today at raising at astronomical valuations. There is no sensitivity to the risk of it at 100. I mean, 100 million to me is the last chance to not go for it. Okay. So I tell every founder to stop at 100 million valuation. If you're not sure you're going to IPO, now you may get it wrong, right? But if your gut says, I don't know, IPO, man, 50% of 500 million, that's not me. Don't raise that north of 100, 1 billion, 2 billion, 3 billion. The kids these days, Harry, the kids, the generation after you, they don't care. They see no risk in raising at $10 billion value. They just don't see it. And so the combination of that and wanting to get into the hot deals means they'll absorb, up to a dilution threshold, they'll absorb lots of capital. They'll just absorb. I don't think it's any more. There's other reasons, but I don't think it's any more complicated than that. I don't think the amount of VCs want to invest in companies that are capital efficient and don't need their money. Excel figuring out how to buy 30% of Atlassian back in the day was the genius move. When I started investing, I think I met with Rich Wong. I'm like, why don't you do all these deals? He's like, we just can't find enough. He's like, we don't want to do anything except Atlassian. We want to be the only investor in, own 20 to 30% of a bootstrap company, right? VCs love companies that don't need their money.
I frankly, not much to add. And that I think, Jason, I love it, Jason, is that we VCs want to invest in people who don't want us, who don't need us. And I love it. We want to invest in capital efficient companies, and we want them, I want to do that in a capital inefficient way. It's a paradox, but it's true. Right? And
do you know what I see more than ever? Insane amounts of AI roll-up plays, whether in legal, whether in accounting, whether in professional services, a lot of home real estate plays. Is this a venture model? Is this not a venture model? How do you guys feel about the AI incentivized roll-up play?
I'm modestly skeptical, which means, ironically, I'm going to start by citing a success. We were investors in Nuance, Speechworks, which became Nuance in 2000. And they were a generic speech recognition company, AI, prior generation, and did a lot of broad corporate stuff. And then they found this vein of gold in medical transcription, right? And the way they built that business over the decade from 2005 to 2015 is they bought crappy little mom and pop transcription companies, injected the AI, and made it work. Right. So there's an example of where it did work over an extended period of time. But, and this is my but, I think it's a crappy model. Right. Just for contrast. Right. You weren't expecting that, were you, Harry?
Why do you think it's a crappy model?
Because I think, you really, the bet you're taking is you buy a set of customers that weren't picked by you because they are suited for your product. They were picked by some mom and pop founder as being the 10 customers they could sell to. And then you come in and maybe your AI is so good it can address all the needs of all 10 of the customers. But in my view, you may find much more likely that, of the 10 customers, 3 or 4 of them, perfect sweet spot. You get them across to being all software. It's great. The other 5 or 6, to a greater or lesser extent, the needs are slightly different because remember, they didn't pick you because of your AI, because you didn't have their AI when they picked you. So you're going to have a lot of churn and people where you can't make it work. It's going to take longer to bring them across. And, and you're not going to develop any new deal muscle, right? So I would worry that you end up just piling in, this sudden mass of services with a relatively low multiple. And I don't know if it'll be a compelling business, right? I mean,
I love that insight that they didn't pick you. I mean, it's obvious now, but I'm gonna take that with me because this isn't something new. It's just in some ways been accelerated by AI, right? This is since the first job I ever had. If you were overvalued, you always look to buy a terrestrial asset on the cheap, right? And tack on 8 figures of revenue. This has been true since the dawn of the internet. But they didn't pick you. That's the problem. They didn't pick you, did they? They're not going to, it's not durable revenue in any way, shape, or form, right? So it's financial engineering is all it, in most cases, what it is.
I would
right?
actually push back on both of you. One of my fastest growing companies has gone from 0 to 30 million in revenue in 2 years with a pure roll-up play, which is helped by AI tooling. And to your point on like the customers not picking you, the customers are all pretty much identical. It's a real estate management product. They are identical in the service that they require, the product that they engage with. There is zero ambiguity. And so the ability to roll out to a uniform customer base makes it a very efficient model, actually. And so the thing that matters most then is just acquisition price. Can you acquire it effectively at a good enough price? What's your speed of turnaround in terms of your payback? And what's your margin juicing? Like we go from 5 to 40% in 6 weeks. That's a big increase in a short time.
Agreed. And the key sentence was the first one is all the customers are exactly the same and it's all tuned to your technology. And I buy that. There'll be examples of this that work. There's examples of everything that work, right? I mean, but the more broad it is, like people are gonna just buying quote BPOs, and
everyone's looking at buying BPOs, right?
Yeah.
everyone's looking at that in the contact center.
The more broad-based you go, the less likely it is to be efficient, right? I'm not saying it's never going to work. I'm just saying it's probably a lot harder than you think. And it really does boil down to this very clearly defined use case where you can be certain that most of them will come across.
Guys, where is no one going that more people should be going? If we're seeing roll-up plays be massively over-invested, I see it more than ever. Where do you think not enough people are?
This is the moment where your little heart inside says, if I knew for sure, I'd be damned if I'm going to tell you, Harry Stebbings.
You're giving me a hard time today, Rory. You're like, delete your filters. You're like, no, you're a hypocrite.
Yeah. Sorry, I just came off a board meeting. It's been a tense day already. So, and it's only 10 o'clock. I think we talked a little bit last time about, we still, both Jason and I, would do the treble, double core SaaS company in enterprise. Normally you try and throw out esoteric areas, but all the esoteric areas are full. I mean, there's people doing rockets, there's people doing defense, there's people doing healthcare. So there's a little part of it that says it's not our focus area, but a partner said to me yesterday, guys, everyone's running away from consumer. Maybe you should spend some time there. And it's not our thing, but if you were a personal investor, whenever you say to yourself, whenever everyone's running away, if there's still a technology that's animating progress, as distinct from just being a trailing edge tech thing, you do have to say to yourself, maybe. But I don't have a ton of amazing new place insight, especially.
It's so interesting you said that. I tweeted and thought this week, like 5 years ago, there were 2 to 3 competitors for everything that we looked at. Now there's 10 to 15. Yep. I just got out of an IC where we were looking at a L&D tool, learning and development tool for Gen AI security. And then it came up with like red flags. And then it came up with the market map. And I was like, well, wait, in the last 12 months, these are the competitors for learning and development in large enterprise for Gen AI tool secure. Oh, God.
Well, I think there are, if you just, listen, I don't have any great ideas of great businesses no one's looking at, but if you just step back for a minute from that, the LMS space, this was already overcrowded before AI, right? LMS was one of these classic spaces of too many vendors for a mid-sized TAM, right? That's the worst area to invest in. I've done several investments like that, but you have to be intentional if it's tons of vendors, smaller TAM.
Totally.
But I will say, just being very tactical, there's not as much innovation in the true enterprise, not B2B, not mid-market, but gnarly big problems. It's just not what all the kids in SF know, right? And so there's always going to be less investment with A and S tier teams solving gnarly enterprise problems, especially outside of security. There's just going to be not that many. There's not going to be that 100 kids that want to build the next service now. There's just not that many. And there's many other examples. And the other one that is obvious, but I think people miss, is there's so much excitement around vertical agents, whatever these are. But no matter how, there's still, I believe vertical SaaS is still underinvested in, because the AI wave is just coming to vertical SaaS. It's just starting in a lot of these categories. And you're going to see 5 competitors, but you're not going to see 500 in a lot of categories. In legal you are, in sales tools, but a lot of categories are not going to have 500 AI competitors. They're just not going to know the markets well enough. So this deep market expertise and enterprise, I still think you're going to have fewer competitors.
Do you guys speak to all the companies in the space? Will you really map it that effect? When there are 10 to 15, will you do that work?
You'll try to, and it's because everyone say you do it all, right? And I do believe at the stage we're at, part of everyone has their model on what works, and if you're doing seed by definition, I think it's really hard to, right? At the stage we invest at, first of all, an observation, which is when you look back on success, it's obviously when you have this market and you can going in picking the winner, to state the obvious, disproportionately greater outcomes, and it's the first stage at which it's vaguely knowable. Maybe that's a better comment. Is that it's all unknowable, right? But there's this early proto market. Everyone has $1 million to $3 million in revenues. You can at least try and figure out who the winner is, right? Do you actually get in front of every company before you can pull the trigger? It's hard to do that, because let's get real. You talk to the first one, you think it's interesting. You'd want to talk to the others, but you might have to make a decision now. So I'm not going to lie and say I never pull the trigger until I've seen all the players. But I'll tell you what you got to be damn sure of. You got to try and figure out when you're pulling that trigger, do I know who the universe of competitors is, and have I a decent sense of how they're doing through Jungle Telegraph, customer references, third-party references, whatever you can. You should do that. You shouldn't be blundering into deals and therefore the fatal error by definition in our stage is this. You fast forward 12 months and it turns out the number one competitor is someone you hadn't heard of. At that point, you should be committing ritual suicide in the boardroom table because you screwed up. And so you do want to have a sense of the market map. You want to have, it's okay. Look, maybe to say the earlier comment more succinctly, you often go into deals and you don't end up in the winner. Duh, that's what losing looks like. But you really don't want to go into a deal knowing up front you haven't got the number one. That's like saying, let's lose money here. We have a good plan, people, right? So by definition, that is kind of one of the key things you just got to do diligence at this stage. Is there some compelling reason why these guys are ahead?
When you look at the distributions that you've had, have they been markets where it is winner take all or much more distributed? Is it an Uber and a Lyft, or is it a Salesforce and a HubSpot and lots of CRM plays and a Viva also for a specialized industry and much more fragmented?
The data says consumer tends to be more winner take all, and enterprises tend to be more oligopolies, right? And we were fortunate enough to be early investors in HubSpot. So yes, we can speak to oligopoly, right? That's just the nature of the beast. And even within enterprise, I would argue infrastructure, where my colleagues invest, tends to be a little more winner takes all, because you don't need a separate router for healthcare versus banking. You just need a router. You just need a GPU, right? At the apps level, the reason it tends to be more fragmented is there are markets and there are sub-markets with real nuances between them. So there's a lot more, because you threw out HubSpot and Salesforce, and you're right, they're both winners in CRM. but very different, to the point where actually Salesforce was an investor in HubSpot early on, right? The markets were sufficiently fragmented that they could both build huge companies in markets that at one soundbite level are the same, but one level down were very different. So much more oligopolies and multiple winners in enterprise apps than either infrastructure or consumer. Jason, does that kind of tie with you?
Yeah, I mean, when I look at the $1 billion exits I've had, they're all in brutally competitive markets that were oligopolical or similar. I wish it was marketplaces, because you'd prefer that, right? I mean, yeah,
Jason,
I mean,
Jason and Rory, can I be blunt? How many 10Xs have you had?
You can. I've had 4 or 5 above a 10X.
Jason?
What does 10X mean? Sorry. You mean cash
10X
distribution? I've only had $3 billion exits, I think, right? So you mean 10X, just 10X deals?
No, 10X distributed cash back on deals.
Well, only 3, but hopefully there's more, right? I think only 3, right? Maybe 4. Maybe I got the math wrong.
It's not the only, dude.
4.
It's so damn hard to have 4. You've been doing it a decade less than me, which is depressing myself. But you said, like, I remember it's so damn hard to get one of those, especially across a cycle, right? Enough with the only. I mean, so many people don't get any. So many people get 1 or 2. I had a decade where I had none. From 2000, and I said this, I think, last week, I am more proud of my 2Xs and 3Xs in 2004 and 2005, 6 than any 10X that kind of sailed into the 21 bubble and made me a fortune.
Rory, did you ever have a crisis of confidence as an investor? And what would you say to young people now who are looking at 20 to 23 and going, fuck, am I actually any good?
I have crisis of confidence all the time. And my most recent today, right? Absolutely. Totally. I mean, it's actually an interesting question. This is such a hard business. And if you don't have angst about your ability to do it, right, you're missing the point. Because in one sense, look, you can say, hey, first of all, starting out of my first 5 deals, there was one point where I thought I'd lose money on 4. I spent 3 years of my life not pretty much sleeping, terrifying, right? I was dreadful at this business. It was 95 early on. So yes, that was one crisis of confidence. Was there a crisis of confidence in 2000, 2010, when I was vaguely competent, but no one was making any money? Yes. Was there 5 or 6 years where you felt amazing? Yes. Do I have more crisis of confidence the last 3 or 4 years when, despite having 25 plus years of doing this, you start making you have deals that make it clear you got it wrong again? Of course you do, right? I think anyone running money in venture or anything else does that. And the question is, what you can't do is say, hey, I was great then, so it'll work out. You have to say, what am I doing wrong right now in today's market? Am I playing the game correctly for where it is today? What did I miss? And just go back to basics and say, I do believe if you do the right steps in the right order, you can't stop mistakes, but you can minimize them and probably do okay across a cycle. When I look back at recent mistakes, I think I skipped a step. Shame on me, right? And when you skip a step, it bites you in the ass. And then you feel like an idiot.
Where do you think your scale is not playing the game correctly today? I'll give you an example for me. Like, I have access to amazing hot rounds, like some of the names. I don't do them because I just think they're crazy priced. They seem completely detached from reality. And then I'm proved wrong consistently.
I see you're turning on me in revenge for your hypocrite comment, which I respect.
Well, I wouldn't say it's revenge. I would say it's more tit for tat.
Challenge.
Yeah, totally. Yeah. Well, I'm Catholic. I've done confession. I can do this. So I think it's one of the things you are wrestling with is you have your strategy, you want to stick with it, and you're right. We all get some version of bright, shiny object, right? Which is like, oh my God, are the returns? You're looking at other things, and you do try and keep it focused on the main chance. A and B rounds with product market fit, early revenue, looking to scale. So broadly speaking, we have kept on mission, right? But I'll say there's sometimes when you say to yourself, I don't want to drift off all the time, but I'd love to be able to do one of the hardest things I think to do in an investment management firm, which is make the occasional exception without making it the rule, right? Which is really hard to do. Can you reach for that $1 billion deal that you see it, you have good connections, you should do it, And it makes a ton of sense without doing the 5 other deals that are massively overpriced at $1 billion. The ability to move beyond your strike zone once in a while is a muscle that's hard to do, but it would have economic advantage if you do it, but would be catastrophic if you did it wrong. That's one area. And I'm sure you have the same, because you implied it yourself, Howie. You see this later stage deal and you go, it's not what I said I'd do. I shouldn't do it. But every once in a while you say to yourself, if I could do, dumb comment, once in a while, should you? I wrestle with that. We haven't.
11 labs at 25 million, I could have had 1% of the company. And I was like, 1%. And like, no way. It was a $25 million fund. It's a $3 billion company now. I would have been a fund returner on 1%.
Well, look, for what it's worth, there's a lot of complexity here, right? But I think any deal where you have 100% conviction you'll 5X, 100% conviction you'll 5X, you should do it irrespective of ownership or valuation, just to do it. If you've already met with the founders, you already believe in it, and you're not thinking you can make money, but you're like, I am 100% sure I'll 5X it. You'll always like to get an extra 5X out of X millions in your fund. It may not return the fund, but you'll never look back when you're in carry mode and say, you know what, if that 5 had become 25, that's an extra $5 million in my pocket. You'll never regret the sure thing 5X. I know it sounds silly, but this is where I started investing and I lost track of it going to this. This is my rule. And this is my rule today again. If I'm 100% sure I'm going to make 5X, then I'll do it, period. Like, no matter what, I'll just do it. I have
a $125 million seed fund. If someone in my team comes to me and goes, I want to write a $3 or $4 million check, I'm going to 5X it, I know, but I don't know if it's going to be. No, this is what
you get to do running the place. Your team isn't allowed to use this heuristic. You're allowed to use it.
It's actually, and by the way, to join the dots, and that's why Jason should be in his own firm. Right, because it's a lot of comments here. I actually think Jason had the right answer, because if you play back what I said earlier, if you establish an exception strategy in a team organization where there's broadly equal team, then it's really hard to rein it in. Right, that's what I'm saying. We're a broadly equal team at scale. We're 7 people who can write checks. If you start breaking the rule once, then you've broken it for everyone. It's no accident that the firms that have high, position betting variance, where they're willing to go anywhere, are single leader dominated. Jason, you're exactly right. If you're running your own shop, that's the joy of running your own shop. You can range high, range low. You're not trying to follow a model. You're not trying to build a thing. So Harry, he's right. If it might be corrosive to your entire culture and piss off your junior people, but the only person who can have the pulling out the exception card is you. We've chosen not to do that.
Rory, Jason's got no other investors. It is just him.
No, well, that's exactly, and then he can. And there's a reason why, the guy in Omaha who doesn't list to anyone is the richest man on the planet, because he's like, thank you all for your opinion. I don't give a shit. Right. and this is the tension always between, building a firm, having a consistent strategy versus, on the other hand, doing the reach. And I think going back to what Jason said, Jason is actually right about his comment on high conviction, because again, with the caveat that it's not an institutional building strategy, but something you said, Jason, that resonated with me. There's a rule in engineering that you're only as accurate as your least accurate variable, right? And everyone gets all caught up with the revenue multiple and the price. It actually is the conviction level you have, if it's informed conviction, not bullshit, I swing from the gut and but if you have high knowledge that this is a thing, right, you've got to weight that extraordinarily highly. Right, because the future is so damn uncertain. Most things you don't know what's going to happen. Most things, a lot of things don't happen. So if you get to that unique insight of this is a thing and it's going to run and run, then finding a way to monetize that bet is actually your job, right? Because there's very few things about the future, right? I remember realizing, oh my God, every single app for the next 20 years is going to be rewritten as SaaS. I should monetize that bet. Right. In the same way, I give all credit to the people who said, like, going back to what I said, like, these AI models are a thing, and you just got to get me a piece of the 1 or 2 that are going to work. Right. When you have the high conviction and you're not trying to build a consistent internal strategy for management reasons, make the bet.
So why aren't you doing $1 billion rounds if you can see 5X plus in them with the core fund?
Because I think, when you're trying as a firm to build a strategy, it's very much that's a very idiosyncratic leader as genius. As what Jason said, is that when you're trying to do leader as genius, making all the decisions, you do that. When you're trying to build a peer team, that are doing deals, broadly speaking, you stick to what you're doing and you have a plan and a strategy, and you just accept the fact that there's going to be deals outside your core competence that work really well, but your job, which is hard enough, is to execute your core strategy really well. I'm far more worried about missing a 5 or a 10x deal that was in the scale sweet spot of 1 to 10 million in revenue, Series A or B, enterprise software. When you miss that, or even worse, when you turn it down, that's when you have a bigger problem, because it's not the, oh my God, I missed the Hail Mary that was outside my sweet spot, which might bother me personally. But in terms of building a team and a firm that's functioning, if you're not playing the system the way you want it, and seeing the deals you want to see in your sweet spot, especially if you've defined down that sweet spot so you can be successful, that's where you should agonize a lot more. It's a difference between personal investing, frankly, and building a firm.
Totally agree. Rory, I'm aware you've got to rock and roll. This has been a pleasure, my friend. Good
to see you guys again. Fun to be back. Good and fun to defend Harvard, which I never thought I'd do.
Do you know what, Rory? You are fantastic, and I'm a hypocrite.
Well, we knew that already, Harry. No surprise there.
My favorite on the last show, when you were like, you'll just edit us all out and just make yourself sound disciplined. I was like, yep, this guy's smart.
Yeah, no, yes, you did last time. Yes, as they say in the civil service, why attend the meeting when you can just write the minutes? Okay. Take care.
Have fun.
Bye.
See you.
Jason, I wanted to ask you one more question before we wrap.
Sure.
And it's actually, you mentioned it on this sheet, which is the Bay now has 82 tech billionaires.
Yes.
Per Henley and Partners, a firm, and going up. Is there any point in being outside of the Valley? And is this the ultimate centralization of talent back towards Silicon Valley, unlike any other time?
Man, Harry, I love living at the beach during that global pandemic. I have a beach house in Southern California. I know all the best brew pubs. It's good living. And, but man, literally, I'm just, I just got a DM yesterday from a new generation tech billionaire. I don't know. I'm just going to go meet him tomorrow in downtown. I'm going to walk to this meeting, and it would never have happened if I wasn't here. It's just one example from this week. Right. And man, the density here, I just keep, for me, the dense, listen, you asked the question, how often do you meet all the companies in the space and investment? I only did it once on my first investment in Pipedrive, and I gave up. I've never done it. I've never reached out to a competitor. I've never done any competitive diligence, right?
What?
Not once. And so the way I invest, the Bay Area is just perfect for it, because I can get to know people for real. I can kind of understand the space. I have some time, and I'm just not the Zoom guy. So I'm just SF is so back.
Why would you not do my partner Paul would literally have a heart attack right
Why
now.
do I not do any?
Yeah.
Because for two reasons. First, do you have outlier growth? Okay. Only so many can have outlier growth. If you're an inception investor, if you invest pre-product market fit, I get it. But if you're saying, listen, I want to see someone growing, ideally this 1 to 10 in 5 quarters or less. Here's the thing, Harry, I only meet a handful of them.
When you do Algolia, when you do Talkdesk, when you do, you name
owner growing it's rocket ship today. Yeah.
Sure. But your Algolias, your Talkdesk, when you invested, your RevenueCats, they were not rocket ships. They were good and exciting, but they weren't obvious rocket ships.
But they had top 0.1% growth. I can pull up the old. No, Talkdesk went from 1 to 15 in 5 quarters. Okay. Algolia was growing 20% a month for the first 2 years. Okay. Pipedrive, as flawed as it was the fastest growing one in the space. So listen, I'm not saying this is the right way to invest. What I'm saying, I got to be honest, I don't meet every hour with a founder growing that quickly that I believe in. I have to believe in the founder, and they have to be growing at 0.1% rates. Maybe you, with your network, every hour you're meeting someone going from 1 to 100 in a week. But I find that plus a founder you believe in, plus that not every opportunity exists for a variety of reasons. You might not meet them. There might be ownership issues, fund size issues. There's a million issues too, because I have such a narrow sweet spot, right? That I have to rule them out if they're too late or too early, that I feel like I have to do every single deal where every box is, here's my point. I do every single deal where every box is checked, and I don't have the luxury of deciding is it really, is there one that's even better than top 0.1% growth, right? And so I'm not saying it's not flawed, but it's worked okay.
Is there any box that you're less strict on it being checked?
Yeah, unfortunately, it's that competition box. I'm super loose on that. As long as the founder has a large piece of white space in the space, I'll do it no matter how competitive the space is, even if I would prefer not to. Everyone would prefer no competition, Peter Thiel, right? I just don't feel like in B2B, to Rory's point, where we're building oligarchies, we have this luxury so often to have no, Windsurf started our competition, it doesn't have no competition, right? I would love to have no competition, but that's the box I just completely have given up on, despite wishing I could check it. No competition. I would, if I could, that would be a gift, but it's the one I give on, and it's harder than ever. Everything is more competitive today, right? Going to your point earlier. So that's the one I give on. I won't give on growth. I won't give on CO. I no longer will give on CTO. We've talked about that in the past. That's one I will never give on again. S tier CTO, or I'm off it, but competition, and I don't care about college. I don't care if you went to high school. I don't care about any of that. I'll give on all the educational crap.
If you have a super competitive market, is the core skill set that you look for in a CEO different to a non-competitive market?
No, because if you're post-revenue and you're growing at outlier rates, you figured something out. And I will be honest, Harry, for every single investment I've made, I have not truly understood its competitive positioning until after I invested. I'll do a lot of internet diligence. Don't get me wrong. Anything you can do on Google or ChatGPT, I'll do it. But to really understand the market, like if you didn't come out of that space, it could take you the better part of a year, 6 months to really understand that market. How are you going to figure that out for sure before you invest?
So, I mean, I'll tell you, the guys will do 30 references. 10 with team, past and present, 10 with customers.
Oh my God, I love it. Yeah. I mean, I just did an investment with Meritech and saw their due diligence. I've never seen something this good in my life. Oh my God, 100 customers they talked to. The notes were I literally said to the founder, you got to share this with everyone in the cap deal. I've never seen such good diligence in my life, right? I talked to 2 customers when I invested in this company. And actually, after the term sheet, I talked to 2.
Do you know what's so shocking though, honestly, dude?
What?
This is just the entry ticket for growth firms to get a meeting now. That's why the diligence is
so good.
Yeah, it's so fucking difficult for them to get in the door with that $7 million, $1 to $7 million in a year ARR founder. That is just the ticket. Hey, it's worth your time to meet me because look at all the work that I've done on your company.
Well, look, for what it's worth, I'll tell you why I have this strategy, right? Yeah. Honestly, at this point, listen, I really do love a lot of the founders I invested in. You talked about RevenueCat. You're right. I invested crazy early. I love the founders. No matter what, I love them. I love a lot of the founders, right? But at a business model, I'm only in it for one big, massive win. That's it. Everything I'm going to do for the next X years, it's just for a whiz or better. I don't care about anything else from a business model. I don't care. So I'm going to do the best I can to find a whiz or better, right, going forward. And anything else, these are just means to an end, right? So I got to check all those boxes. And I think if you invest in enough folks in that top 0.1%, and you're lucky enough to do them, one of them will hit. One of them will be worth another true $8 billion outcome, not fake $8 billion on paper, but a real $8 billion outcome, right?
How able do you think you are to know whether you'll invest before even meeting the founder? And I know that seems strange, but if you know the market, the traction, the competition, where they sit, the background, revenue growth, how able?
For me,
yeah,
90, every single time I've known I want to invest before the first meeting, 100%.
Dude, if you get everything you need and you meet the founder and they are just boring, they're uninspiring and dry, do you do the deal?
Dry?
Yeah, like just dry. Like you're just like, ugh, they don't excite you.
Never met one. I never met a founder that could write an incredible email, express incredible excitement about a boring industry. I've never met a founder that could get me excited by email, that when I met him, I'm like, this guy's just dull, because they're already so passionate about their business. Anyone that is like that passionate about their business, it's like you could meet that, whoever makes the best mugs in the world is going to be fascinating. I would love to talk. Let's bring the CEO of Shure on 20VC. Going to be fascinating, right? So I've never met a CEO with this outlier growth that's crazy, that didn't go to college, that dropped out after a month to do a podcast, whatever. I've never met this person and they're not interesting. It's just, I've gone to other people's meetings. I've gone to other VCs meetings where I literally wanted to cry from boredom and bang my head, but I've never once had a founder that legitimately passed the bar pre-meeting where I didn't meet him. I'm like, this guy's pretty interesting. An owner is going to be it's a huge success. Okay. But I don't think I've actually invested in a company with more competition than owner. Not a single one. They direct competitors, adjacent competitors, virtually identical competitors. Like I've never, I don't know why. And Dean, the CTO, is so good. And that's why I invested. But why is that? Just because like you can play with the app doesn't make it fun to invest in, does it?
And in a shit market, like every investor does this, and they always go, look at who's the winner now. Dude, Noah is great. Love Noah.
Great founder.
It's $1 billion, just $1 billion. And it's been 15 years, fucking brutal slog.
Yeah. But listen, and I'm only an expert in Olo from afar, right? But Olo is a story of doing the wrong end of the tail. Right, Olo is trying to do basically an enterprise play in an SMB market. That's really brutal, right? It's the same problem in anything in B2B e-commerce. If you're not doing some SMB in e-commerce, like there's a few niche players, but like it doesn't make sense to fund it. Even take with Shopify, only 25% of the revenue is big brands, right? So if you're only big in anything that's like the consumer end of B2B, you're going to be niche, right? You're going to be niche, right? And the niche competitors to Shopify are dead or dying like Salesforce, right? And Olo is great, but it's like high end, right? It's chains and stuff like it's hard. There's just not enough TAM.
Do you know what I love? The amount of amazing founders, and I don't think I've told you this, and I didn't mean to rub it in, but the amount of amazing SaaS founders who tell me like, you're friends with Jason? I emailed him and he never responded. And now I'm like $1 billion company. And I'm like, I would love to have invested in everyone Jason didn't respond to.
Well, that's why really I just want to do it. All I want to do is one whiz, right? That's all I want to do for the next 1 year, 10 years, or 15. That's the math, right? None of the rest matters, right? But I got to do better. But actually, honestly, Harry, the AI is already going to solve half that problem for me. Yeah. And so it has a rule, and I'm still tweaking the rule. But if the metrics are good enough, it forwards an alert to me to look at the deal. So now it's better than an associate. Honestly, it's better than an associate. Like it will review your deck. It'll provide you feedback. You can iterate. There's no pressure, right? You're not being judged. The AI does not judge you, but the AI is better. It will provide you all your feedback on your TAM, it'll tell you how good your growth is. It will compare it to other investments. It will tell you whether you're in the sweet spot. It'll tell you the check size we do and the ownership size we do. And then you just set up a trigger. Like if it hits these numbers, just send it to me.
Dude, I love talking to you. You've been amazing. Thank you for doing this. And I so appreciate it, man.
All right. Let me know what else you need, man.